Keith. Keith is, just by way of background, he was a founder of 2 unicorns. He was a co-founder of TechCrunch with Michael Arrington, and they created Crunchbase. He's a data guy, right? And he said, Kayvan, I was the chairman of this fund in Europe called ADV, which Legal & General, which is a large European insurance company, was the sole LP. It was a $380 million fund. And he goes, we put a small amount of money around this thesis that how would the returns be if we provided the follow-on capital to the top seed funds in the top companies. And after 3 years, they had a 20x return on that small portion of the fund. Keith was all excited. Legal & General got scared. and so Keith goes, you know what, let me step out. I want to do this. He reached out to me because we've known each other, but we never did business with each other. He goes, Kayvan, I did this thing. There's a tremendous opportunity here. Let's do it. So we basically, for a year, worked on our thesis, did all our research on the data, hired a couple of data scientists, some great data scientists, quite frankly. The guy that built Amazon's SA platform and Netflix's recommendation engine. And Keith had worked with them in other ventures, and so we put this team together. About after 2 years, we built a product and we started fundraising, and we're now making investments. And basically what SigmaRank does, in a nutshell, is we score every single round of investment that happens globally in every sector at every stage. And what we do is we go into those top 10% of those deals at Series B by providing the pro rata capital to the seed and Series A investors. So all our deals are the best deals of Sequoia, Andreessen Horowitz, Lightspeed, Khosla, Google Ventures, the top, and we get into their best deals. And we don't even have to talk to them, even though we do talk to them. And so we have all this data. And I do not know of an opportunity for any LP or investor that could get into these deals with the minimum check size that we're asking for. And we even made it even simpler because we actually believe that, venture is kind of like an exclusive club, so to speak, but the ecosystem that support it are a lot larger. So how can we provide access to those people too? And so when we decided to build this venture, this fund, we said, let's disrupt it in a good way. So we're actually structured as a company, as I mentioned earlier to some people. And the other thing that we do, we provide liquidity at any time for our investors too, which funds do not do, and there's no capital cost. We also issued a finite number of preferred shares for our investors, and 98% of that money is all going towards investment. We leave up to 2%, we'll never use that much of it, of deployed capital for our operating expenses. And it's that simple. We issued 40 million shares. Our goal is over the next 5 years to raise over $1 billion. So the share price today is cash, $25 a share. We've made 7 investments. We started investing in April of this year. I'll show you guys the companies that we invested in. And so the price of the stock today is cash, but one of our companies, which is right now, just signed a major deal with the DoD. It's a cybersecurity company for governments and law enforcement. And so, backed by Andreessen and Sequoia. But now we're going to see probably the first quarter, because of this big deal that they have, they're going to probably raise more money now, and at a lot higher valuation. So we're already seeing an uptick in 5 months, in our stuff.
Because since you are issuing shares, anybody that invests later will also cap the investments.
They'll get, our price of our share is basically an outside committee determines what the share of the NAV of the portfolio is, and that price goes up.
Yeah, exactly.
One benefit that I'll share with you guys, up to the end of this year, those people that come in, they lock in the price. We give them 100% warrants at the price that they came in, and the number of shares that they invested in. So for up to 2 years, well, a year and a half, they'll have, even when the price of our share goes up, they're still locked in at the base price of $25 a share. So great opportunity. Thank you for coming. Just to also note some other initiatives that I have, that companies I own. I own an incubator in San Mateo in San Francisco. It's called Innowise. We mostly focus on corporate innovation and so forth. We're doing a big event on February 29th. We're inviting a bunch of CVCs and heads of innovation of corporations. It's by invitation only. And we've developed this corporate innovation platform called Total Innovation Management, which basically takes the principles of total quality management with the Lean Startup methodology and helps large enterprises spin out companies and engage with the outside entrepreneurial community. I'm actually writing a book on it, but whenever I have time. And then another initiative that may be interesting for all of you guys is, we've done a partnership with UC Berkeley, and we're building an AI academy for emerging markets around the world.
That's really nice.
And then on top of that, we're putting another fund for all those best companies. So
Who at Berkeley are you working with?
we're working with the Blum Center of Entrepreneurship, so the School of Engineering, and we're right now we're going to do a beta of it in Turkey and in Kuwait, and so that's another initiative that I think we want to also bring it to Brazil. Basically, we have an amazing network. People they say they have mentors. We actually work our mentors, and these are people, at an executive level that are either running multinational organizations or, are senior leaders of those organizations as our mentor group, and we take advantage of their experience and their willingness to help startups, because at one point they were a startup. So the list that we have as mentors, is probably by far one of the best that we have in the world, that you can see in any organization that has it. Because we're structured, that part of that entity is structured as a B corporation. So it's a partnership between the nonprofit, UC Berkeley, and this B corporation that we're establishing. Because we think that in this case, the B corporation is the most appropriate because it's a for-profit entity that does good. So we're not purely profit-driven, and it also helps us engage with a lot of nonprofit organizations in the world, because it's really about raising the tide globally around AI. So those are the things that we're doing. But today's conversation is signal rank.
Let's go.
Let's kind of go. Let's go. So when it comes down to it, we are think of us as a systematic investment company. We have now built these algorithms and that identify the best companies, and we figured out a way to get in. What you'll see here is that, and we call this pro rata as a service. We have basically, when we back test our data, because our track record is our back test. Basically, we have a 1 in 3 chance.
Can I
Sure, please.
do some comments? So when you talk again, pro rata as a service, because you are asking for the seed and Series A investors if they want to go to the Series B, and do you invest the same percentage to keep their percentage in the same way?
So we don't ask them. We tell them that we want this company.
Okay.
They already know that company is good.
Okay.
And we say, if you already have existing LP relationships, great. But if you need any money, we're here to give you the money.
Okay.
And in all the cases so far, they say,
Yeah.
absolutely, yeah.
Yeah, okay.
Because we also give them good economics.
Okay.
We give them a 20% carry.
Okay.
So you'll see also that, when we did all our research on all the...
Just again, sorry.
Yeah, please.
So when you do the investment, you are managing this amount, this percentage, so it doesn't consider for the representation that they own in the company in terms of votes or monetary, how you decide how to vote to decide between?
Yeah, so the I guess the question you're asking, it does not really affect their fund performance. Because this is
Because they're being diluted in some way, right?
yeah. So what happens? Yeah, they don't. The way we do it, we offer it to the GP,
Okay.
right? We give them a 20. We structure an SPV, which we pay for, we manage for them. Upon exit, let's say it's $1 million, right?
Sure.
We give and we structure the SPV in their name. So it's, whatever fund, this SPV. We give them $1 million. Upon exit of that company, because we don't give money to the fund, we give it money for that specific company. Upon exit, we get our $1 million back. And then let's say it's sold for, exit for $10 million, right? We got our $1 million back. So there's $9 million left. They get 20% of it, we get 80% of it. But what we do is we redeploy that capital. We never distribute dividends. We're constantly putting the money in. And that's why we give the investors the ability to leave when they want to, because we will never distribute.
Sure.
So you just sell our shares, and when you want to come in and come out, and there's no capital calls because we're not structured that way.
Kind
So
of
it's-
an ETF almost.
yeah, basically, yeah. The other thing that we're doing is we plan on listing the company because we really want to provide access to anybody that wants to. And if for some reason we don't list the company, obviously after 12 years we say that we'll just dilute the company and distribute the dividends that way. The other thing that since we have all this flexibility, we said, you know what? We can now, at the 3-year mark, we have a structured sell of 50% of our holdings into the secondary market. Take that cash, keep half of it, let it grow. Take the other half and invest in more companies.
Mm-hmm.
So we're taking advantage of the power law of money, and basically making sure that we can get into as many deals of the best companies in the world. And so right now, our biggest cost is our legal costs. We work with Paul Hastings, which is one of the top funds, law firms in the country. We work both with the Silicon Valley outfit and the New York office because we have to set up everything to list this company from today, and so make sure that there's no issues when we decide to do that. The nice thing about all that is that when we spoke to NASDAQ and the SEC, they said because of how we take $1 and over a 10-year period invest it 3 times plus the proceeds, that we will trade at 2 to 4 times of NAV. Whereas a regular fund, that listed, and I used to be part of one, it was called GSV Asset Management or GSV Capital, it traded at a discount to NAV because it basically distributed its dividends,
Okay.
right? But because we don't, and we redeploy it, they're saying we're going to trade at 2 to 4 times now. So this company is a high growth company, and we're only going to do it, if all the conditions are right.
Mm-hmm.
So, and the other thing that you'll notice is, because we're dealing and investing in the top decile of companies getting funded, those are naturally the top funds in the world, right? It's the Andreessens, it's the Corsolas, it's the Union Squares, of those guys. And it's not only in their funds, but it's in the best portfolio of those companies. So
But what understood about structuring a vehicle that you can invest in a diversity of funds without.
well, you're investing in a diversity of the portfolio companies of the fund, the top funds, right? You're not investing in the fund.
You're investing in a
Excellent.
company that holds.
That rounds are led by these top funds, right?
Mm-hmm.
And we, as a go-to-market strategy, because our historical data said the top 200 seed funds have been, responsible for investing in all the unicorns in the world. As a go-to-market strategy, we reached out to those top 200. However, when a company we identify as becoming a potential unicorn gets invested, anyone on that cap table can take our capital, because at the end of the day we just want that company. and we don't care, great for anyone else who's on it, so.
And you're paying a fee for these funds, there's a 20% carry.
We'll give them a 20% carry.
That's why they're allowing you to
Of
get-
course, right? Yeah, because they want to do an opportunity fund. How difficult it is to put that money together in a timely fashion, and usually it's about a 15% carry that they get, or 10 to 15% on an opportunity fund, right? So we made it really easy, and even with those economics that we're giving, our returns are outstanding. We outperform any fund in the world, at least based on our back test.
Yeah.
And but we're already seeing an uptick in our NAV, and we've only started making investments. It's been how many months now? May, I think it says here, end of April. So it's 5 months.
Yeah.
So the model's working. We have access. We're identifying the companies and everything else. So we always say our logo is the next unicorns have already raised the Series A. Because remember I said that we work on a 3-signal system. So we look at every single round of investment that happens, we score it. And so we know that, and those companies that outperformed at seed, we'll see outperforming still at A. We want to see that they're doing that trajectory. Then we reach out to all the investors on that cap table and say, depending on who's leading the round and the amount of that Series B, and and we have to obviously, make sure that all the due diligence is done. You got this capital up to $5 million, right? And so they go, great. And so we're getting more term sheets. And then, by the way, if there's a company that one of our partners thinks that should be on this list that's not, give us the name of the company, tell us who the investors are, because not everyone inputs the data into Crunchbase or PitchBook or Carta. So we say, just give us who the names are, we'll score it, and we'll say yes or no immediately. It's that simple.
Yeah, you have to score money and
Yeah.
collect the data.
So, the whole idea is, as I mentioned, we could get into these fast growth companies early. And by the way, even though at Series B, it's 1 in 3 that, we could think that it's going to become a unicorn. At Series A, it's actually 20%. So, our algorithms, when we back this, it says, hey, Series A could be also a good investment here. However, we're just sticking to Series B because we our long-term picture is, we also see us as a wealth management platform. And so, it's the best, way to get into venture in the most risk mitigated way for those people who don't have access like we do.
So
right?
can I ask another question? Like
Sure.
when you did the back test and you select specific investments, the way that you get your money back is much more through the IPO, or it's much more through an M&A transaction that the
We don't care.
You don't care.
We don't care because all we're going to do is take that money and redeploy it anyway. But just to let you know, less than 20% of unicorns exit.
Okay.
Right? That's why, we will never sell, and we provide opportunity for our investors to exit through selling our stocks, right? Because certain people maybe want the return money back in 5 years, right?
Yeah.
Some people want to hold it long term. We want to provide that flexibility for them.
So, and the other way, you say like 8% get exit or 7%.
20%. 20% exit.
Okay, 20% exit. The other you hold probably for quite a while.
Yeah, we'll just while and
Keep
we'll just,
holding,
yeah. But because we're constantly investing, right?
Yeah, sure.
That's why we sell 50% of our shares. Because 50% of our shares, we know that some of these companies, say private anyway, let's just sell in the secondary market, let's get that capital.
Just like in this scenario, when they do the exit, they will start, let's hope, to provide dividends, correct?
Right.
And these dividends come to the entity. They are not distributed also, but they are just super as a value to the stock because of your.
So what happens is this, right? Our stock price is an aggregate, from an outside audit committee that tells us, hey, this is value of the NAV, paperback gains of your company of your portfolio. They're distributing dividends to us, right? We just do nothing about that. All we do is just put the money back into our balance sheet, right?
Okay.
And that's all we're doing. We never distribute. You either constantly buy our shares, hold our shares, or sell our shares.
Yeah. Your shares are based on your value portfolio and your cash that you have.
Exactly. Yeah, and that's how we do it. So, and unlike traditional funds, you can get out whenever you want, and there's no capital cost. So that's and that's why we think that our platform.
Warren Buffett's like that, right? So, but not straight, but you invest in a company. Right?
Yeah.
The same.
We just using algorithms to invest in the companies, and we create. We didn't want this investor portal that we have was because of our engineers and data science, the product people. They built this thing for us at first, and then we go, holy crap, this is this is a product. So
a technical question.
Sure.
When you invest in a company, how you mark the company value? You keep the last round.
Whatever, until that valuation is whatever the price was set by the lead investor.
Okay.
Until the next round.
Until the next round.
Until the
You
next
kept
round.
same value.
We keep the value.
Okay.
Yeah. So this is the kind of the interesting point about. Go ahead.
Let's go a bit interactive. But in terms, when you have the investment agreement, you receive all the statement reports that the funds they receive and distribute
Oh, yeah.
for the LPs at the same
Yeah,
level.
same level.
You have access to this information.
We require it.
Oh, okay.
We require it. Yeah. So this is kind of interesting. Remember I told you that the top 200 funds, right, the seed funds, are in basically almost all the unicorns, right, at seed and A, right? So that's our mark. That's why we partner with the people on the right, the top 200, right? And we've identified them because we know their performance, right? And if you look at the top funds, global funds, multi-stage funds, at seed, they've done 70, or at seed and A, they've done 70 unicorns, Sequoia 38, Tiger 19. They mostly invest in unicorns later stages, right? And by the way, the ones that they do early, they don't let people in anyway, right? However, those top 200 seed funds are, by far, are investors in more unicorns than these top 3 funds. However, we use their fund performance and their involvement as a way to score these companies. Because when they're in and they identify a company that's a unicorn, I'll show you the data. They know what to do. When they identify a unicorn, they bring in the right investor.
It's a fulfilled prophecy. Okay, they have the means to make them
Exactly.
They have the results that you will become probably a unicorn because if you do your basic, I put money on you so that it makes.
They have all the resources to do it, and then what happens is seed investors kind of get left behind, right? And that's why there's that huge gap. And we're adjusting that gap. That gap, by the way, is, go ahead.
That's one of the things that Sequoia, I think last year, they ended that older structure to divide the per stage funds, and they have now a structure that's only one bunch of money, only one.
By the way, they're structured as a company like us too.
Yeah, they just ended last year.
So yeah, that's why we kind of said, they're onto something.
They did this change.
Yeah, they did that change, and so did we. Well, we didn't do a change; we just structured this off this way. So this is really interesting. What I told you, and we showed this data. Seed investors, okay, or investors in general, only do 1.2 rounds of follow-on investment in their best deals, and it's only because of capital constraints.
Sure.
Right. So my partners are partners at Menlo and Sequoia at my house, and I was talking to them. They said, Kayvan, we will use your capital because even though we have more money than possible, and we have all these opportunities funds, sometime we can't get access to it because of whatever reasons. Right. The CFO goes, sorry, we can't take money from this fund, and this fund right now is depleted, or whatever it may be. So they said, we will, not all the time, but even sometimes we will use your capital too,
Right.
because, whatever reasons we can't do it. So, this is all just kind of a lot of our, but this is the next important thing. This opportunity on average of untapped pro rata and unicorns, that companies that we've identified unicorn, is $1.2 billion a year. That is the amount of capital that's left on the floor. Opportunities that the seed fund knows that company is good, but they just couldn't get the capital in time to do it. And so that is our market. So this is basically telling you that, we built it, we've done all this, we've built a platform. We have 2 platforms. One is for our partners to do their pro rata, and the other one's for investors. The one for the partners we just show their portfolio of the companies that we're tracking, and then they can just submit the term sheet, and we do the due diligence. We ask for access to the deal into the data room, and they get the money wired to them automatically because we already know what companies we're going into. And we already know what, because once they get to raise the Series A, we inform the seed manager and say, hey, these companies we're tracking, depending on what they raise in Series B or how much they raise, they could qualify. And so they know ahead of time. And so we're helping them also. It's like ease of mind that, hey, for this company, I know that I have the capital when they do raise.
So another question. Suppose that we invest through the LP that she's creating. You give access to the platform to her.
You better be real good friends to her.
Yeah, but the idea is that all our investors will have access.
Yeah.
Okay.
So we give it to whoever the SPV is.
Okay.
Right? So
Jupiter.
It's up to them, Jupiter.
To share.
Yeah,
the
that's up to
access.
them,
Okay.
what they do. We'll close our eyes.
Okay.
But yeah, it's only to the investors.
Okay.
So, this would be a unique situation because, we want, when I came to Brazil and I saw the challenge, is what? Series B rounds are not happening in Brazil. These
Yeah.
companies have to move to US or wherever they need to use, right? And so this is a nice way to help those seed investors have done all the work, have all the relationships,
Yeah.
and now they could at least monetize. By the way, we're doing B, but as we go along, we're going to do B, C, and D. So you can now, as an investor, you could tell your founders, hey, listen, if all goes well, we will follow on with you. So it's also really important as you do this to make sure you have those rights, right? Because for the right company, and for the founder, if they like you and they say, okay, here's a partner that's going to help me, give me access to Silicon Valley funds or global funds, quite frankly, because we're tracking funds globally. We score and track every single fund at every single stage and every single GP globally too, right? Because sometimes a GP will leave a fund and start his own. So we let his performance follow him for 5 years, and only 5 years, why 5 years? Because we want to see how he performs, right? So anything he's done before 5 years, we don't care. By the way, because 2021 was such a crazy year with Tiger and and SoftBank putting a lot of money in, kind of blowing out the valuations. What we've done is in our algorithms, we know that a company that raised a Series A in 2021 with high value 5 years back. Okay. So, by the way, I have it on a mobile app too, so you could literally, do things. So we're basically an index. Think of us as an index, and that's why we think wealth managers will love us down the road, right? Because now we're giving anyone access to venture capital, without really, because the return still as an investment vehicle, the top quartile, the top 25% of funds outperform any type of investment. The average IRR is 38%. So when we back tested our, data going back, 12 years, I think, where it was our model. Here it says 26%, but that's the average over 12 years. I'm saying going back 12 years, but going back 5 years, it's actually 30%, 30 to 33%. And here's another thing that's important: that 76% of the Series Bs go on to raise a Series C and beyond, right? So our companies, no matter that we identify, are going to raise more capital anyway. So even if they don't become unicorns and don't exit, we're still going to see a return. So these are some of the people that we've now co-invested with. And by the way, this is natural. And by the way, it's all the industries that are trending, right? Biotech, cybersecurity, all the, platforms, AI, because the algorithms doesn't say, oh, let's look at this industry. Venture capitalists determine what industries are hot because that's where their money is going, right?
Mhm.
And so our algorithms pick those up. It's that simple. So here's this, I've kind of shared this, but this is kind of the offering. We're Delaware C Corp, right? We basically set our NAV at quarterly. We have an audit committee that determines what that value is. Today it's still the $25, even though we've already made 7 investments and we're making 3 more in the next couple of months. Our NAV is still the same because our portfolio, has just raised that Series B, right? As we get returns, we're just recycling the capital. The economics are fund-like, right? So even though we're structured as a company, for investors, it's like you're investing in a fund. And plus, right? Because you have liquidity, there are no capital calls, and so forth. And our goal is right now to IPO in 2027. If the market's not good, we're not going to do it. If it is, we will. So the everything we do, we're not tied to it. We're just trying to optimize the ROI. But we have put in the money.
No, just a question. In terms of regulation, how do you see yourselves? Because technically you are working as a fundraising structure related to invest in companies, not in a fund style, or not the fund regulation. How do you navigate between, maybe...
That's a good legal question. I'll let, if you have one, I can answer the questions from Paul Hastings, which is a global reputable fund. But the question is specifically, how are we viewed from the regulatory perspective?
Yeah.
Okay. So we are looked like as an investment company. So we're treated like an investment company, and there's, I don't know the terms of it, but there is a type of investment company that we're looked at. But everything we've done, the reason I say our biggest fees, our costs right now, is not our people, it's our legal fees, is because we have said from day one we engaged Paul Hastings and said, this is our plan. And so they brought in the SEC, they brought in NASDAQ, and they said, okay, these are the things that you need to do in order to make this happen. So, but I think we're structured as there's a term, and I'll get the name for you, of what kind of fund, but it's nothing special. It's, we're doing everything so that we can be a registered investment company.
Yeah, I appreciate
we are limited in this structure to 99 investors. And then we have to 99. But internationally, unlimited.
Yeah.
99 US investors, internationally,
But
unlimited.
SPV is
Yeah,
based
one investor.
in here, right?
We are gonna structure. I am gonna send you guys the details.
Okay.
That's not. I don't know exactly, but I think it's it's gonna be here, and then we might have to. I don't know. Again,
But
like
that quite my question would be, can I invest through, if I have money here in US or in Brazil?
You're gonna be able to do both.
But either way,
You're
just so
gonna
you
be able
know,
to do both. We're gonna have
Jupiter
both
will
structures.
benefit either
Yeah.
way. Anyone that Jupiter brings,
Yeah.
they'll either get paid,
Oh, okay.
No, but
Yeah.
even here, we're gonna probably have like both options, right?
Okay, we'll talk later.
What I understood, I spent a lot of times looking for regulations for cross-border operations. Or Jupiter can have like kind of a feeder fund in Brazil that it will send the money here. Okay.
Yeah, we already have that.
By the way, our investments
Yeah.
that we made are obviously, majority of them are in Silicon Valley, but we also have investments in Israel. We also have investments in Europe, and in Germany and in England. By the way, we want to invest in Brazil, so we already have some companies in
Show
Brazil
us
that
the
we're trying.
platform.
So this platform is global, right?
It's incredible.
Yeah, and by the way, just very quickly on the team, Keith is the CEO, I'm the president. we are the three on the left are the founders, us three right here. You know, Matt is basically managed hedge funds. He's in New York. Keith is here in Palo Alto. Keith is the one I told you that, you know, he's our data guy. At his heart, he's a data guy, really smart. My background, you know, and these are our two main data scientists. These are our initial investors, right? So I don't know if you guys know Gary Tan. He's the CEO of Y Combinator. Lip-Bu Tan is probably one of the most successful investors. He's on the board of Intel. He's invested in 130 unicorns as an individual. You know, so just an amazing guy. Dan Rose is Coatue Capital. Blake Grossman created index funds for Wells Fargo. Faraj Alais had 2 successful exits. He's on our board, you know, he does a syndicate investments. So he has a syndicate of 40 high-level people. When he puts in money, they all come in money. So he's an SPV investor. Tim Draper, I'm sure. I don't know if you guys all know Tim. Glenn Catcher, Lightspeed. He was one of the founders of Tiger. Harris Barton is a fund of funds. Vint Cerf invented the internet. So, you know, we're basically an amazing group of companies and so forth. Let me kind of show you a little bit about, so the way it works, this is kind of, I'm showing, you know, our back end of our platform. We take the raw data in the form of APIs from, the API integration is from Crunchbase. And because Keith, you know, was one of the co-founders, we have access to data that's not publicly available in the APIs, but we have APIs into Crunchbase. Do you guys know Preqin?
Yeah.
And Preqin and Carta. Okay. And then we also scrape some data, small amount of data, because we want to validate some stuff from PitchBook. But the APIs into those things. So we get that raw data, and then get it into Amazon. Then we go into Snowflake, basically, where we create the dashboards and the algorithms and everything else. And then from there, we take a small sampling and we create a portal. And so that portal can be designed any way we want to. We have one version of it, but we're building it right now so it can be fully customized to our investors so that they can use it. We're not selling our data. A lot of people say you should, but that's a completely different business model. But we said, since we already have the portal, let's make it available to our investors so that they can benefit from it. So let me just kind of show you a few of the dashboards. I mean, here we can show you all the worksheets that we have, all kinds of. We have sliced and diced this data in multiple ways. So we first started in a heuristic model, okay? But now our machine learning model is beating the heuristic model, which is nice. And so, you know, heuristic is more algorithmic driven, right? And the learning model, its foundation is that, but now it's becoming smarter than us. And so we use both just to make sure there's always some validation on it. But the learning model is beating our heuristic model right now. Not by much, and before it was the other way around, but you know, it is doing well. So, and by the way, where it is today outperforms any venture fund in the world. So it's already good, but it's going to get better. So let me kind of show you the macro view. This is, so as I said, we're tracking every single round of that's happening. This is a global view, right? So if you look at it, let me open up this. So, you know, we do it, you know, you can see here, you know, this is all funding rounds. Here is all by, you know, pre-seed, right? You know, we can see that. And how, you remember I said from pre-seed we go to the 3 signals, right? So we, you know, here's by seed, A, B, you know, C, D, E, you know, so we're basically tracking everything, right? And I'll just kind of share with you a little bit just so you can see some information here. But, you know, in 2023, right, there are 32, so far this year, 35,000 rounds that have happened, right? We know what the median raise, we know what the gross raise is, we know what the average raise is. Compared to 2022, right, there was 41,000, right? or 46,000 rounds, right? And in 2021 it was 49,000 rounds. So we're tracking all the rounds, right, that are happening. And we're tracking the performance, average amount raised, and all this other stuff. And then you could go to like, you want to look at Series A,
This is,
right?
globally, right?
This is globally. We're looking at things globally. Yeah. So we don't care where these companies are coming from. In fact, we've always thought of ourselves as global citizens. And my background is that. I personally, the reason why I started this with Keith is because I thought, you know what, we are global citizens. Keith is British, American. I'm an American Iran. I was born here, but honestly, I feel myself as being a global citizen. And that's why Plug and Play was so interesting to me. If you look at, NOIs, you'll see that our vision is to basically develop a global standard around innovation and entrepreneurship without bias to geography, race, gender, or creed. That's kind of who we are. And so what we wanted, I feel that I am fortunate enough to be here in Silicon Valley. And so I want to make sure that I can basically support people around the world who have a similar vision around innovation and entrepreneurship, and for me to be able to leverage my experience and expertise to other markets around the world. And that's just who I am as a person. And every company that I have has that mission in it. I have another company called Peach Score, which basically scores like a FICO score for early stage companies, for pre-seed and A companies. I'm on the executive chair and board of that one. So, that's and that is a platform that, we could bring to Brazil too, so that they can compete globally, right? Because that is also a global platform. But you can see kind of like, as I said, we slice and dice everything here. Let me go back to, let me show you this other piece now. This, by the way, this what I'm sharing with you. Just keep to yourselves, because